Welcome back to the Motivated Mind Zone. Glad to have you here. Today we are diving deep into what is, well, arguably the most paralyzing challenge in personal finance. Moving money from simply sitting stagnant as cash to actively investing it.
It sounds like such a basic calculation, doesn't it?
Mm.
Cash sitting idle is losing value, so logic dictates we should invest. Yet, this decision point, it creates massive inertia. Our sources, we're looking at money journalists, consumer rights experts, wealth managers, they all confirm this. And it's true whether you're a high-earning professional or someone just, starting to build savings.
Absolutely. Our mission today is to cut through that noise. We are unpacking the core psychological roadblocks that prevent action, trying to demystify the complex jargon, and really provide a clear, actionable roadmap for establishing long-term investment success. We have a robust stack of analysis here on the current financial landscape and, critically, how you can overcome that fear of getting it wrong.
What's fascinating here, I think, is that the central conflict isn't really a lack of opportunity or even a lack of capital. It's this emotional barrier. The moment people consider investing, they just feel overwhelmed by complexity. And this failure of confidence, it often stems from a deep misunderstanding of risk and, crucially, a highly documented psychological trait we really need to address right up front.
Okay, let's unpack this cash conundrum then. To start, we absolutely must validate the times when holding cash is the right strategic move. It's not always paralysis, right? We need to separate the necessary buffers from the purely emotional reactions.
Yeah, the sources are very clear on this distinction. There are basically three valid, practical reasons to hold larger sums of cash. First, if you have a defined short-term goal, and we're talking anything less than, say, 5 years away, like meeting a deposit for a house or funding a big wedding, something like that, that money has to be liquid and safe. Can't risk it.
Okay, makes sense. What's the second?
Second, if you are already in retirement, your financial objectives just pivot entirely. It becomes about capital preservation and predictable income. Liquidity becomes paramount because you are now drawing down on that capital. You're not accumulating it anymore.
Right, drawing down, not building up.
Yeah.
Okay, and the third?
And third, the absolute non-negotiable prerequisite, the essential emergency savings buffer. We're talking about 3 to 6 months of your necessary income, immediately accessible, probably sitting in a high-yield savings account if you can find one. That's your financial fortress. It's untouchable. Don't invest that.
Right, the safety net. Beyond that essential calculated buffer, however,
Right.
well, that's where we seem to hit the emotional wall. Inertia kicks in, driven by that sheer psychological barrier. And this is where we need to introduce the concept of loss aversion bias.
That's right. Loss aversion. It's a really well-known driver in behavioral economics. We are fundamentally wired, it seems, to feel the pain of a loss about twice as strongly as we feel the pleasure of an equivalent gain. It's quite powerful. So even if the rational decision is clearly to invest, the potential pain of seeing that investment temporarily drop by, say, 10%, it feels so visceral, so real,
Yeah.
that we often choose the safe option of holding cash, even though intellectually we know that cash is actively losing purchasing power.
And that fear is just compounded by the perception of jargon overload, isn't it? So many people feel they must immediately become some kind of technical expert before they can even start, which is just paralyzing. They look at the industry and see all this complexity, maybe assume they need to study for financial exams just to understand the entry-level basics.
hmm And that intimidation factor is significant because, let's face it, financial institutions and sometimes the media often use impenetrable language. I mean, think about the research showing that 1 in 5 people, that's a huge percentage, 20%, had never even heard of a stocks and shares ISA. This is a fundamental tax-efficient vehicle specifically designed for regular people to begin investing easily. So the main accessibility tool itself is unknown to 20% of the population. Well, it sort of validates their belief that this whole world is just too technical for them.
Yeah, it creates this artificial ceiling, this feeling of, it's not for me. The sources really emphasize that this perception makes the process seem like it's only for an elite few who've spent years studying it. And it holds people back even when they recognize logically that leaving large sums of money in low interest accounts is, well, financially suboptimal. It's losing them money.
But the reality is, the modern investing landscape, largely thanks to technology and these low-cost funds we'll talk about, it's dramatically simpler than the, antiquated systems of the past. As one specialist noted in our materials, they actually took those financial exams and it was, quote, no fun.
Hmm.
The average person just doesn't need that depth of knowledge to get started. They need clarity on a handful of core principles, which is what we're focusing on today. The perceived complexity is honestly far greater than the actual complexity required for initial success.
Okay, so this shifting perspective is really crucial because it brings us to this counterintuitive concept of risk. We worry obsessively about the risk of market volatility, those short-term losses, but maybe we need to reframe that view entirely. Sometimes the biggest risk is actually not getting started at all.
It's the risk of absolute certainty that your money will shrink. That's the real risk of doing nothing. People get caught in the trap of trying to time the market, waiting for the perfect political climate or the mythical economic bottom,
Right.
which, as the sources constantly remind us, just never seems to happen. You can wait forever, and by waiting, you are incurring the guaranteed cost of inaction. And that cost has a name: inflation.
Yeah, the cost of inaction is brutal because it's the silent, slow-acting killer of wealth. It just creeps up on you. If you leave cash in accounts earning less than the current rate of inflation, you are actively sacrificing purchasing power year after year. Let's make this number concrete. If the projected average inflation rate for the year is sitting around, say, 3.5%, that is your hurdle. That's the number to beat.
Exactly. So if your cash balance is sitting in an account earning maybe 1%, perhaps optimistically, you have a 2.5% gap right there. That means mathematically you are becoming poorer by 2.5% every single year in real terms. What your money can actually buy is shrinking. Compound that over a decade, and that money will have lost a substantial portion of its real value. You need to be earning more than that 3.5% inflation rate just to stand still financially.
And the flip side is that the long-term historical trajectory of investing, particularly in diversified assets, has always been upward, provided, and this is the key bit, you stay the course through the inevitable peaks and troughs. You have to ride it out. That confidence comes from understanding the math of the market cycles, not the daily headlines.
Hmm. And we often absorb these sort of antiquated beliefs about investing, don't we? The image we hold is often based on maybe our parents' or grandparents' generation's finance, memories of balancing paper checkbooks, making calls to brokers, navigating all this complexity. The sources highlight that this perception makes the process seem laborious and manually intensive,
Mhm.
which simply isn't the case anymore in the era of digital platforms and low-cost passive funds. Things have changed a lot.
So the core philosophy we're really taking from the sources here is the power of time in the market. It's the absolute antithesis of timing the market. The research is pretty compelling, isn't it? Simply investing a regular amount and holding those assets dramatically increases the probability that your investment pool will gain value over time. It survives the market downturns and benefits from the rebounds eventually.
Yet, this is a direct challenge to that emotional urge we all feel to pull money out when things look bad or scary. If you look back at the 2008 financial crisis or the sharp COVID-19 dip in early 2020, those who stayed invested generally recovered. But those who panicked and liquidated their holdings near the bottom, they locked in their losses permanently. The power of time. It smooths out that volatility, and crucially, it leverages the compounding effect where your earnings start to earn returns themselves. That's the magic.
It truly is about behavioral discipline then. It's like committing to the gym. You know you should go. You might put it off until tomorrow. But once you take that first regular step, you start forming the habit. And that habit is what drives the long-term physical benefit, not some single miraculous workout session. In finance, that habit is often automation, which I know we'll discuss later, making it automatic.
Definitely. But before anyone rushes off and sets up a direct debit to buy their first fund, they absolutely must undergo a non-negotiable prerequisite self-assessment. This is the know yourself stage. It determines whether you are financially and, just as importantly, psychologically prepared. You need to assess your personal situation, your eventual goals, however vague they might be initially, and your genuine attitude toward risk. How much uncertainty can you stomach?
Yeah, and I would strongly echo the sources here. You really should not be moving into long-term investing if you have high-interest debt. We're talking things like credit card debt, maybe expensive personal loans. The guaranteed return you get on paying off a 20% interest credit card vastly outweighs the likely but still uncertain return you'd get from investing that same money. Pay down the expensive debt first.
Correct. The very first questions are you managing your high-interest debt load effectively? Is it under control? Do you have that emergency savings buffer, that 3 to 6 months of essential expenses firmly in place? And crucially, do you have sufficient insurance? Things like life insurance if people depend on you, health cover, maybe income protection. To ensure that a major life event won't force you to suddenly liquidate your investments at a loss. If the answer is no to any of those prerequisites, those are the priority. Sort those first.
Okay, foundations first. Once those foundational blocks are squared away, then you move to defining your investment goals. And this is really about setting a time horizon for the money, isn't it? How long can you leave it untouched? The rule of thumb here seems absolutely critical. Investment is generally not recommended for less than 5 years. Why is that number so important?
Yet the rationale behind that 5-year minimum is essential. Markets are not linear. They don't go up in a straight line. They move in economic cycles that typically last several years. Ups and downs. You need that minimum time horizon to ensure that if a major correction or a dip occurs right after you start investing, which can happen, you have the necessary runway to ride it out, to recover without being forced to sell your assets at a depressed price just because you suddenly need the cash. It allows you to invest with genuine conviction, knowing you can wait.
Okay, 5 years minimum. But these goals, they don't have to be instantly complex, right? People shouldn't panic over needing to create some super detailed 5-year plan for retirement on day one.
Oh, not at all. If your initial goal is simply preventing the stagnation of your savings buffer, making your cash beat inflation, that is an excellent starting point. Just aim for growth above inflation. The goals can and probably will evolve as your life progresses. You might start with a general growth goal, then maybe refine it later for a specific purpose, like university funds for children down the line, or perhaps a house upgrade in a decade. The key is just starting the mechanical process. Get the ball rolling.
And this feels like the perfect moment to fully dispel that myth that investing is only for the already wealthy. Because the financial barrier to entry, it seems to have just evaporated in the modern era. So many potential investors hold back because they think they need, I don't know, a 10,000 pound lump sum just to be taken seriously or for it to be worthwhile.
And that's completely false now. The specific minimum cited in our sources is actually very reassuring for a lot of people listening, I think. You can start a proper, regulated investment journey, for example, through a regular savings plan on a low-cost platform or app with as little as £50 a month. £50.
Okay, but I need to challenge you on that a bit because this is maybe where the jargon comes back to bite. If I start with just £50 a month, how can I possibly achieve the level of diversification you've hinted is so important? Isn't there a risk that starting too small makes the process feel a bit pointless or maybe forces me into unnecessarily high-risk single bets?
That's a really great point, and it's exactly where technology provides the solution. You don't use your £50 to try and buy 50 individual stocks. That wouldn't work. Instead, you buy a small slice of a highly diversified, low-cost investment fund. Think like an exchange-traded fund, ETF, or an index fund. These funds might track the performance of, say, 500 different global companies simultaneously. So your 50 pounds immediately grants you microscopic ownership in hundreds of major corporations across the globe. You achieve instant broad diversification. The barrier is gone because these funds allow for what's called fractional ownership. You can buy tiny pieces.
Right, fractional ownership. So the point isn't the initial amount. The point is taking that first disciplined step and realizing that it is absolutely never too late to start leveraging the power of compounding in time. Just get started.
Exactly. Now, once the decision to invest is made and that first step is taken, the critical strategic mindset must be adopted, the long-term view. As the wealth experts consistently advise, you must accept that you are in this for the long haul. 3 to 5 years is really the necessary minimum time frame to see through a full economic cycle and assess true performance, not just short-term noise.
And this is where the behavioral control gets tested, doesn't it? I love the source materials analogy here. Investing is test match cricket. It's not a bungee jump.
Mm.
It should be methodical, long, and ideally actually a little bit boring. If it's exciting, you might be doing it wrong.
Huh. Yeah, it's the perfect analogy because in test match cricket, the day-to-day score might look abysmal sometimes. You might be losing wickets left, right, and center. But you're focused on the overall 5-day game, the long game. If you find yourself having heart and mouth moments every week with your investments, that's a clear warning sign. It almost certainly means your risk profile, the types of assets you're holding, is misaligned with your personality and your goals. You are probably invested in something way too volatile for your nervous disposition, and you need to review your strategy, maybe shift towards more stability.
That emotional control also means avoiding the trap of being glued to your investment app, constantly checking performance. Checking daily or even weekly means you're focusing on noise, not the signal. Daily fluctuations are largely random. They just tempt you to panic sell during a dip, which is almost always the worst thing you can do for long-term returns.
Mhm. And the key strategic defense against all that external volatility, the wars, the inflation shocks, the political shifts we can't control, is the principle of diversification. This is your primary tool for mitigating the inherent risk of participating in the global economy, spreading the risk.
Okay, let's define true diversification with a bit more clarity. Because it's not just picking, say, 3 tech stocks and 2 retail stocks, is it?
No, not really. True diversification means spreading your capital across different types of assets in different geographies, so different countries and regions too. For instance, you spread capital across 1, shares or equity, which gives you ownership in companies and exposure to their growth potential. 2, bonds or debt, where you're essentially lending money to governments or corporations, which usually offers more stability and income. 3, unit trust investment funds. These are pools of money managed by professionals who invest across various assets. And 4, ETFs, exchange-traded funds, which are baskets of assets, often track an entire index like the FTSE 100 or S&P 500, that trade like individual stocks on an exchange.
Can we just briefly contrast a bond versus a share again? Because that feels like a foundational difference in risk that people need to grasp.
Absolutely. A share represents ownership in a company. It carries higher potential reward because the company might soar, but also higher risk. The company could fail entirely, and your share becomes worthless. A bond, on the other hand, is debt. You are a creditor, you've lent money.
Hmm.
It typically carries lower risk because the government or company is legally obligated to pay you back the principal amount plus interest payments along the way. Though there is still some risk known as default risk, especially with corporate bonds if the company goes bust, but generally less risky than shares. Diversification means balancing this risk-reward ratio across different types of assets.
Okay, that's clear. And the practical difference between an ETF and a unit trust for a beginner.
Sure. A unit trust, often called a mutual fund in the U.S., is typically valued only once a day, based on the closing price of all the assets it holds inside. An ETF, however, is traded constantly throughout the stock market's opening hours, just like an individual share. Its price fluctuates during the day. Honestly, for a beginner investor looking for diversification, both are excellent tools. ETFs often come with slightly lower management fees and maybe a bit more flexibility because you can trade them anytime the market's open. Unit trusts are often bought and sold directly via a fund platform. But the core purpose of using either for diversification is simple. If one area, let's say U.S. tech stocks, has a bad year, hopefully the others, maybe European shares or government bonds, won't decline simultaneously. It smooths out your overall return and mitigates that localized risk.
Right. Don't have all your eggs in one basket or even one type of basket. Now let's talk mechanics. The practical way to implement this long-term diversified strategy, and crucially to overcome that inertia we started with, is often through automation. This is known as pound cost averaging or dollar cost averaging elsewhere.
Exactly. Pound cost averaging just details the simple strategy of setting up a direct debit automating a fixed money transfer, say 50 pounds or 100 pounds, to drip feed money into your chosen investment account regularly. Like clockwork, maybe on the 5th of every month.
What's the specific benefit of doing this automatically with a fixed amount rather than saving up a bigger lump sum and trying to dump it in when you think the market looks low?
Well, the benefit is actually twofold. It's both behavioral and mechanical.
Mm-hmm.
Mechanically, it smooths out volatility. Let's say you invest 100 pounds this month when the unit price of your fund is 10 pounds. You get 10 units. Next month, the market drops and the price is only 5 pounds. Your same 100 pounds now buys 20 units. When the market eventually recovers, your average purchase price across all your units is lower than if you had bought all 30 units at the initial 10-pound price point. So you end up automatically buying more units when prices are low, when things are on sale, and fewer units when prices are high.
Ah, okay, so it takes the guesswork out of trying to time the dips and the behavioral benefit.
Behaviorally, it just solves the procrastination problem and the fear factor. The ultimate benefit is that it creates the investment habit. Like our gym analogy again. You don't think about it, it just happens. That regular automated savings plan acts like the alarm clock. Ensure you stay on course, stick to your plan, and don't let the fear of market timing or daily news headlines interfere with your long-term goal. It builds discipline.
Okay, as we transition into the real mechanics of accessing this money down the line, the crucial watchword for the listener seems to be liquidity. This is basically how quickly you can get your hands on the money if you actually need it right now.
That's it. And even though we're strongly advocating for long-term strategies, most regulated investments like funds and ETFs are actually relatively liquid. You can typically wrap up funds and receive the cash back in your bank account in a non-massive time frame, usually just a few business days. However, this just reinforces why that separate cash buffer, that 3 to 6 months of income, is so utterly crucial.
Right, because if you need immediate cash for an emergency, you absolutely don't want to be forced to sell your long-term investments during a market downturn just to pay an unexpected bill. Doing that would permanently lock in a loss at potentially the worst possible time. Your cash buffer provides the safety net. It lets you wait out the downturn if life throws a curveball.
hmm We also need to quickly map out the risk spectrum. This usually depends on two main factors: your time horizon and your personality. If you are younger, say under 40, you might have a 25-year plus time horizon before you need the money, maybe for retirement. That means you have more time to recover from major market dips, so you can potentially afford a slightly higher risk allocation, maybe even some carefully researched individual shares, which carry more volatility but potentially higher growth.
Okay, and on the really high risk side, we have things like highly concentrated investments, maybe betting big on one sector or going full in crypto, which, as the sources suggest, is typically not recommended by mainstream advisors due to the extreme volatility and the lack of underlying economic assets tied to a real company's performance for many cryptocurrencies. And on the lower risk end,
Yeah, on the lower risk end, you typically look at things like government bonds, lending to governments, generally seen as very safe, or those low-cost, broadly diversified passive investments like global ETFs that track entire indices. They spread risk very widely. But this is key. Your risk tolerance must genuinely align with your personality. It's not just about age. If you know you're the kind of person who is going to obsessively check the apps, lose sleep over a 5% drop, then a higher risk strategy is simply not suitable for you, regardless of your long time horizon. Adjusting risk downwards to match your comfort level is often more important for staying invested than chasing those last few marginal percentage points of potential return. Find what lets you sleep at night.
Good point. Let's briefly clarify for anyone who's still hesitant. What exactly are stocks and shares? It sounds complex, but it's actually a very simple layperson's concept that helps demystify the whole process.
Absolutely. In simple terms, when you buy a stock or a share, you are purchasing a tiny piece of ownership in a real working company, whether it's a giant like Coca-Cola or Apple or a much smaller tech startup. Owning that share allows you to participate directly in its economic success, potentially through receiving dividends, a share of the profits, or through growth in the share price if the company does well. You benefit from the broader economy.
And that is what fundamentally contrasts investment with gambling, isn't it? It's not just rolling the dice.
Exactly. When you gamble, the odds are structurally set against you by the house. The outcome is designed to be zero-sum or, more likely, negative-sum over time for the player. When you invest, particularly in a broad, diversified fund, say an ETF tracking the top 100 global companies, you are essentially betting on the sustained long-term growth of the global capitalist system itself, which historically, despite many bumps along the road, has always trended upward over the long term. You are not betting against the house. You are trying to align yourself with overall economic expansion. The odds are more in your favor over time.
Okay, so to navigate all of this complexity, set the correct risk profile, choose the right funds. The role of advice becomes important for many people. You don't necessarily have to start with a full, expensive wealth manager, but seeking some good financial advice, at least for building the foundations, seems vital from the sources.
Yes, and a crucial point here is the scope of advice you might need. A good initial advisor will often first look at your overall personal finances, your budget, your expenditure, your debt structure, your emergency cover, before even discussing where to specifically invest your money. Get the basics right first. A full-service wealth advisor who offers bespoke portfolio management and ongoing reviews might only really be warranted if you have a substantial amount to invest, say over £100,000 perhaps. Simpler needs, especially when starting out, can often be met perfectly well with more basic, lower-cost services.
And we have several options now for accessing advice and managing investments, right? It's not just one size fits all. You can go the full DIY route, researching and picking funds yourself on a platform. There's a hybrid approach, maybe using a pre-managed fund portfolio, but having access to human advisors for guidance when needed. There's the fully advised route for comprehensive, personalized service, usually more expensive. Or there's robo-advice, which uses automated algorithms and online questionnaires to provide basic, low-cost portfolio recommendations based on your stated risk tolerance.
Correct, lots of options. But regardless of the route you choose, the absolutely critical element here is protection and regulation. Any advisor or platform offering investment advice or management in the UK must be regulated by the Financial Conduct Authority, FCA. Check they are on the FCA register. This regulation brings important protections, including potentially the Financial Services Compensation Scheme, FSCS. This means if the regulated firm itself fails, goes bust, your money held with them may be protected up to a certain limit, currently £85,000 per person, per firm. Unregulated investments, like certain cryptocurrencies or esoteric schemes, carry inherently higher risk, precisely because you lack that regulatory safety net and oversight. If it goes wrong, your money could be gone.
And if something does go wrong with a regulated firm, like you feel you got bad advice or were treated unfairly.
Then the Financial Ombudsman Service offers a free, independent service for consumers to make complaints about regulated financial activities. It's a valuable recourse. So sticking to regulated paths provides a significant layer of protection.
Okay, Regulation is key. Now, let's talk tax efficiency because this is central to maximizing those long-term returns. The key tool here in the UK is the ISA, the Individual Savings Account.
The ISA is crucial. It acts like a tax wrapper. It shields your money from the tax man as it grows. You can currently put up to £20,000 per tax year into ISAs in total. If your investments grow inside the ISA wrapper, those gains are protected from capital gains tax when you eventually take the money out. And any dividends you receive from shares or funds held within the ISA are free from income tax too. It's a very valuable benefit.
And we need to distinguish between the cash ISA, which is primarily for short-term savings and maybe housing your emergency fund, and the stocks and shares ISA, which is the vehicle specifically designed for long-term growth and market exposure through investing. You can use your £20,000 annual allowance across both types or put it all in one, but the stocks and shares version is where the potential for real long-term growth lies.
Exactly. And there's a similar, but arguably even more powerful mechanism for long-term planning, particularly retirement. The pension, often accessed via SIPP, a self-invested personal pension.
Right. The pension. How does that work in terms of tax?
Well, the SIPP is also essentially an investment wrapper that shields your investments from tax as they grow. But it has a massive immediate benefit, tax relief on your contributions. When you contribute money into your pension, the government effectively adds money too, reclaiming the income tax you originally paid. If you're a basic rate taxpayer, for every £80 you contribute, the government cops it up to £100 inside the pension. Higher rate taxpayers get even more relief back. Furthermore, many employers offer matching contributions through workplace pensions, which is essentially free money. This immediate guaranteed return boost from tax relief and employer matching makes the pension typically the largest, most valuable investment vehicle anyone holds over their lifetime. The main catch is that the money is generally locked away until you reach a certain age, currently at least 55, rising to 57 soon.
Okay. ISAs and pensions are the big tax wrappers. But a quick awareness check on risk is necessary here too, isn't it? Even with these valuable tax wrappers, we need to acknowledge that government policy and tax rules are always evolving. They can change. Changes to contribution limits, tax relief rules, or accessibility ages can impact these savings over the long term. It's a risk that needs awareness. But it should absolutely not be a reason for inertia or not using them. They are still hugely beneficial.
Absolutely agree. It's just something to be aware of in the background. And finally, while we're on mechanics, we must address the insidious impact of fees. This catches so many people out. Always check the terms and conditions in the small print for all charges, platform fees, fund management fees, trading costs. A seemingly small annual fee of, say, 0.5% or 1% might sound negligible day to day. But over 20, 30, or 40 years of investing, those compounded fees can consume surprisingly significant chunks of your eventual return. Diligence on keeping costs low is critical for maximizing your long-term success. Hashtag outdoor.
Okay, so to try and synthesize this entire deep dive then, the journey to smart investing starts not with complex trades or needing hours and hours of research, but really with that psychological victory over the initial fear and inertia. Just getting started.
The core journey involves clear, methodical steps we've outlined. First, know yourself, nail down your goals and your true risk tolerance.
Yeah.
Be honest. Second, secure your prerequisites, pay down that high-interest debt, finalize that emergency buffer, get the foundation solid. Third, start small. Remember, £50 a month is enough to begin building the habit. And finally, focus ruthlessly on time in the market, supported by diversification and making it automatic through vehicles like ISAs and regular payments.
And it's crucial to remember that your investment strategy is not static. It shouldn't be set in stone forever. It will change as your life circumstances change. As you get older, you'll naturally probably want to move from a higher risk strategy towards something more income focused and cautious as you approach retirement. And as your confidence and maybe your expertise grow over time, you might transition from being fully advised to adopting a hybrid or even a purely DIY approach. The strategy needs to evolve with you.
Yeah, smart investing, as we've hopefully shown today, isn't really about outsmarting the market or picking the next big winner. It's much more about disciplined habits, leveraging tax efficiency smartly, keeping costs low, and ultimately making the money you already have work much better for you. Starting early helps massively, but starting now is always better than never starting. Stay the course.
We mentioned earlier that pensions are, for most people, the largest single investment they will ever make, often worth more than their house eventually. Yet they're often the most misunderstood and, frankly, feared subject in personal finance. People just don't look into them.
Exactly. So we want to leave you with this final thought to explore on your own, building directly on everything we've covered today. Do you actually know what your largest existing investment, your pension, is currently invested in? Do you know what the underlying assets are? Are they high risk, low risk, diversified? And maybe just as importantly, do you know what fees you are paying year after year for that crucial long-term vehicle? Find out, because that deep dive into your existing strategy, understanding your biggest asset, will likely be the next most crucial step in your ongoing financial literacy journey.